Thank you for attending our webinar tonight. So this evening, we're going to be discussing how to find money for your deals. We also have a very special guest speaker tonight, Mr. Fausnaught. So if you have any questions for him or Nhan, be sure to put it in the chat below. Just type it out in there, and we'll get to it in the order that they were received near the end of the presentation. And be sure to specify who the questions are for, just so they're not confused. So yeah, without further ado, please welcome the man himself, the founder of Fortune Homes, Mr. Nhan Lam. Nhan, are you there?
Yes, I am. Nicholas, can you hear me?
Yeah, I hear you.
Okay, perfect. Well, thank you very much, everyone, and happy the first day of July 2020. We have officially finished the first half of 2020, and hopefully everyone's got a chance to accomplish some great things in the first 6 months of this incredible new decade. Yes, we did have a rough start for the entire country and the entire world on the entire planet with regards to the coronavirus. However, I really believe that regardless of what kind of tragedies or obstacles or disasters are there, those who overcome or have the ability to become resourceful to overcome those challenges always end up succeeding regardless of what situation may come at them. Okay, so guys, we do this every single month, and every month we have a separate topic. And tonight's topic is actually a very popular one. It's how to find your money to do your real estate deals. Now, we are streaming on Facebook Live as well. So we do have an audience both on Facebook and also here on Click Meeting. So definitely, we're looking forward to providing some great information and some answers to some great questions at the end of this presentation to help you guys find the money for your deals. Now, how do we start in real estate? For those who don't know me, we started about 10 years ago. And one of my biggest philosophies in real estate is to be able to find great deals and also find the money to do those deals without using any money out of your own pocket. And that's one of the biggest challenges that people have, is to find the good deals and also find the money to be able to do your deals. And people stop real estate or not even try real estate because of those two challenges right there. So let's go ahead and solve one of those challenges, and that's how to find money for your deals. Okay, so we'll go through these slides here, and then we'll go through each section here. So first of all, guys, as a sophisticated investor, right, what's your mindset? Some people have invested some money in the stock market, into a 401k, into a mutual fund, into a money market account, and different types of investments. And some of them maybe even invest in real estate. But if you think about it, guys, when I finished college and I got my very first job, I still remember talking to my very first financial advisor at Wachovia Bank. For those who don't know Wachovia Bank, they were bought up by Wells Fargo many years ago. However, in my early 20s, I had my first full-time job, was making some great money, and now has disposable income to invest. And I met with this advisor who was probably in their late 50s to early 60s. And the first question was, well, Nhan, what age do you plan to retire? And at that point in time, I was in my early 20s, and I said, well, I would like to retire around 30. So that was roughly 8 or 9 years from then. And he started laughing at me. And then, the moment he laughed at me, I realized one thing. I'm getting an advice from someone who has not yet retired. All right. I want to retire by the age of 30, but I'm trying to get financial advice on how to retire early from someone who has not done it themselves. So I realized a lot of things on that day, and that the advice that I get is not only important, but also the source of where the advice came from. The people who are teaching me and mentoring me, have they done what I'm trying to accomplish? If not, then I should definitely reserve my judgment and not buy an opinion from someone who has not accomplished what I want. And I remember, guys, in this financial meeting, he would advertise the great returns on the mutual funds, the great returns on different hedge funds and capital gains and things like that. And he said, well, Nhan, a very good return is roughly 6%, 7%. And you're lucky if you're going to be very aggressive. A very good return on an aggressive fund, if they're doing well, is 12%, but there is more risk involved. Okay, so my question to you is, what is a good cash and cash return or an ROI in real estate? And you compare that with what people are doing in the stock market and mutual funds, some people are satisfied with 5%. Now, is that 5%? And the answer is no. Okay, how about 10%? Is 10% satisfactory? And the answer is no, not in my opinion. Okay, and then how about 25%? Some people get really excited about 25%. And the reason why is because if you say 25% on Wall Street, they're going to think you're a genius, all right? Especially if it's year after year annual growth. Well, guess what, guys? That is still not satisfactory for me. What I want to earn is what we call infinite return. Now, how do you get infinite return? Well, the equation for return on investment is the amount of money that you invested. I'm sorry, the amount of return that you get divided by the amount of money you invested. Well, if you invest no money out of your own pocket, then that's a zero in the denominator. And I remember from my engineering class that if you have a zero in the denominator, the number becomes infinite, okay? And what that says to you is that you can earn as much money as you want without being constrained by your own personal finances, okay? So how do you do that? How do you get infinite return on investment? Very simple. OPM, other people's money. If you don't know how to use other people's money on real estate, you'll become very successful in real estate investing. All right. Well, what types of other people's money are available for real estate investors? Well, we have hard money. Okay. And hard money is not hard to get. It's just what people call it because the hard money is backed by a hard asset. In this case, it's real estate. All right. There's also private investor. Keyword is private and not public. Okay. Private meaning that you're working directly with an individual or in a family or maybe a private fund of money that's not regulated by the federal government or the FDIC. Also, equity partners, all right? People who want to partner with you on deals and have an equity share of the profits. And then, of course, for those who are very familiar with mortgages, because maybe you bought a house yourself, there's also conventional loans, all right? That's still out there. And also the seller financing, your own personal equity through your 401k, your IRAs, and of course, there's your own cash. Now, again, why did I put cash last? Because that's the last thing I would use, and only would use that if I'm in a very crunch and need access to something very, very quickly, okay? Now, let's go through hard money is this, okay? What is this? Money that's backed by a hard asset. Now, to go through this actual hard money topic here, I have one of my good friends who's actually an executive in sales over at Washington Capital Partners out of Falls Church, Virginia. And Washington Capital, guys, I cannot speak enough of these lenders. They became the #1 hard money lender in the entire DMV area for the last several years in a row. Okay, consecutively, and they're still growing and branching out to new states and new territories as we speak. And they're very resourceful. They're backed by people who actually do real estate investing themselves, and they're not just a lender. So that right there says a lot in itself on how they underwrite deals because they know exactly what investors are going through. Okay, so to go through the topic of hard money, I have Mr. Jared, executive sales from Washington Capital. Jared, are you on?
Yes. Can you hear me?
Yes, I can. Go right ahead, sir.
All right. Well, first of all, thank you so much for having me on, and team. You guys put together an amazing presentation as always. We're a big supporter of the Fortune Homes team and all that you guys do, and we appreciate you having us as part of your journey. So thank you so much for that. Thank you for pulling up the slides there as well. Let's talk quickly, high level. I'm going to try to point out a couple of big trends that we're watching. So just to get into it again, my name is Jared Fausnaught, Director of Sales for Washington Capital Partners. As Nhan alluded to, we're the largest hard money lender in the DMV and actually in the Mid-Atlantic. Last year, we closed $360 million in origination. So to give you some perspective on that, we've basically doubled or tripled the growth of our origination year over year for the last 5 years. So really huge growth, Inc. 5,000 fastest growing companies. We've done a lot right and a lot wrong. We've got a long ways to go, but we have seen really strong resilience in getting through the most recent kind of financial dip and COVID-19, and we're excited to continue to grow and expand in this new and changing environment. So just jumping into this, as a private lender, as a hard money lender, we see things from kind of the top of the mountain, right? We get to see a little bit of surveying the land below in terms of, we know a huge chunk of the deals at any one time that are happening in the DMV area. And so it's easier for us to have a larger sample size, right? Whenever you're doing a poll or you're doing any kind of scientific research, the smaller your sample size, it's going to be harder to get, and it'll skew what's actually happening as far as the results go. So, for us, the advantage is we have all of that loan data. And I love giving these kind of higher level topics on market data, in addition to just telling you why I think you should work with us, and we're a good partner to a lot of investors out there. But the high level talks are really great because we have that data to be able to use. So and so local at the same time. So the first slide, I wanted to touch on COVID's impact in real estate. The biggest impact from COVID has been uncertainty. Let's call it what it is. The reason the market started to fall apart in the middle of March through late March, and luckily have started to come back, but the initial kind of collapse was due in heavy part over investor and consumer overall feeling in the market, not only in the markets, but obviously how that trickled into the financial sector. So, we saw a huge fall off in, kind of around the 15th to 17th of March. And this was in large part because of all of the margin calls that started to happen, among Wall Street banks. And so this trickled down to the rest of the financial industry, including many hard money lenders. To set the stage really quick, most people don't really fully understand the capital structure involved in real estate finance world, but since about 2015, most of the hard money lenders out there have tapped into institutional capital. From 2010, kind of after the ashes of the financial crisis and things started coming back through about 2015, the yields and the returns really started to diminish among various asset classes. And so Wall Street money, various funds started to chase better yields, and they targeted and looked at the SFR space as an opportunity to get better yields. And so you had major Wall Street funds backing local and regional hard money lenders, which then drove down prices, right? So we saw this big trend from 2015 to Q1 2020 of dramatically lowering rates across the board in the hard money space, to the point where we were competing with local banks at 6-7%. So this was a huge price pressure downward, a race to the bottom, if you will. And that really shaped the overall last 5 years of the playing field. What you had, unfortunately, with COVID and all of the consumer fear and financial fear over what's really going to happen. At the time, there wasn't the CARES Act that was passed. There wasn't any, trillions of dollars injected into the system. So a lot of people just didn't know what was going on. So there was a lot of uncertainty that caused obviously a huge crash in the market. And it created, like I said, all these margin calls with banks. So this was a trickle down effect because so many of the hard money lenders were using institutional capital. So it's obviously more complicated than that. I'll stick with high level here. Long story short, the new trends that we're seeing moving forward are a divergence among hard money lenders and potentially even banks. So within the hard money lending community, you've always had kind of more mom and pop shops that just lend whatever amount of money they have at the time. Those folks will always play a role. They're great people. Rates are relatively comparable, but at some point you run out of money, right? Then there's another group that has tapped into institutional capital to be able to scale. And in the past, those rates were substantially lower. And so, now because that isn't as available, it's starting to come online, and I'll talk a little bit about where we're going in the next quarter. Obviously, today is the start of the first quarter, and we're going to see how Q3 hopefully is better than Q2. But the divergence really is hard money lenders that have access to credit lines, access to banks, warehouse facilities, basically anything where they aren't having to sell notes into the secondary market, right? And so there were a whole host of these type of lenders that cropped up overnight, right, within the last 5 years, so to speak. And they tapped into this institutional capital, and they were selling their notes, right? And so now that the secondary market has completely reorganized itself, and during April, late March, early April, was completely offline, those people went to the sidelines. Those private money lenders, hard money lenders, completely exited lending at all. And I'm sure many of you saw this if you were continuing to do deals during that time, or maybe had deals that you were about to close. Now, those folks are still somewhat on the sideline because the secondary market hasn't come back online. And so April was a big retooling month for many people that had built their business models around that. Thankfully, we hadn't. We have multiple lines of credit, warehouse lines. We have a Reg D fund where we've raised millions and millions of dollars from friends and family, institutional investors, and so a whole host of people that allow us to continue lending. And early on, the big difference we saw was changes in rates and terms and stuff, but that is slowly starting to come back online, which I will get into shortly. Just to finish off kind of the impact on real estate, because I got off a little topic. Effects on demand, the key things that we're focused on are, obviously shape of the economic recovery. How do we continue to determine the direction we're going and really make sure that this is in a positive direction. There's still a lot of concern over another shutdown. Could there be multiple waves? Of course, there's going to be multiple waves. Will there be an actual shutdown? Maybe, probably. So the big question that you probably hear a lot of talking heads discussing is it going to be a V-shaped recovery, or is it going to be a W-shaped recovery, or a U-shaped recovery? The reality is it's probably a W-shaped recovery, and slowly increasing over time. So I think at this point, a V-shaped recovery is just not in the cards. I think the market, from a stock market standpoint, has already priced that in as far as the risk. And I can tell you that we in the real estate financing world have already priced that in as well. So the only people that may not have are the secondary market folks and the Wall Street funds that have still yet to fully come back in full force. But what do we need to avoid a W or a less intense W? We need decreases in cases, right? We need target 10-year rates. So one big canary in the coal mine is really the bond market at about 0.62%. So that's kind of a big metric that we're looking at to show confidence long-term in bonds. And that's a general indicator of the overall finance world's opinion of long-term economic prosperity. We need to see at least flat, but hopefully positive mortgage applications, right? We've seen some really positive news from the Mortgage Broker Association as of May 2020, which is some of their most recent data. They are up 10.9% year over year from 2019 May. So that's been really big, right? However, we're not, we understand that that one can play with the numbers, right? And the reality is that there's a huge percentage of these mortgage applications that are actually refis. So while there may have been an increase year over year, even though we're going through, the biggest financial disturbance since the Great Depression, the reality is that like about 63% of all applications that the MBA is seeing are actually refinances. So of course, the Fed has lowered rates to its, one of the lowest of all time. We're seeing, hovering in the low threes in many cases on mortgage rates. If you're not a jumbo loan, not in the jumbo loan world, and you have the right credit and everything else associated with it, that's about kind of the low point that we're seeing in many ways. So it is a little, it's a little deceptive that it's not obviously all purchases, but the reality is that this is a big supply-demand equation, right? So that's what we're looking at heavily to understand what is the direction of the real estate market. And I think, we've really been saved because supply is so low. The reality is right now, inventory is down year over year, again, per the MBA at 29%. So we're seeing a pretty dramatic decrease in inventory. It was already tight before, but now sellers are afraid to list their homes. They don't want people coming in their homes, potentially, infecting them and their families. So it's dramatically closed off the ability to find other deals. And that obviously affects you, not just in the mortgage world, but when you're searching for off-market deals. So one of those trends we've seen is a bigger reliance on wholesalers who have access to the marketing machines that they've built to generate more off-market opportunities. That's just the nature of the game. And many of the home purchases that are happening are from flippers. So there's a lot of, I think right now, the supply-demand equation is really what's saving us. And there's historical data for this too. We've read a lot on past pandemics, SARS in 2003, the Spanish influenza, obviously. And if you look at the historical data surrounding what happened with the real estate market, which is really cool, they actually documented a lot of this. The reality is that home prices generally, on average, did not change at all, if only slightly dipping, and you had just no supply at all. So it's very, very indicative of what's happening now, except here in our case, we're actually seeing home prices, skyrocketing. Again, that supply and demand equation. It's not mirroring it identically to some of those past cases, but we're seeing one of the other issues that we're tracking is affordability, right? So the only thing we're concerned about is, could many of with the increasing home price costs, could this be pricing out a large portion of your possible buyer base? So I think that as a strategy, you should definitely, if you're flipping homes, consider staying in smaller out sale prices, right? You're going to be protected because you're going to have a much larger base of buyers if you're available to FHA buyers, as well as conventional and cash buyers, right? If you're going to do condo conversions, try to stay under 700,000 per unit, even more ideally 500,000. So we're seeing still days on market very, very low across all of the data that we collect from all of our houses. I mean, we're talking about under 2 weeks in the vast majority of cases of all of these loans that are now paying off. And right now we have roughly 350 million out on the street of active loans. So that gives you kind of the scale that we're talking about this data. So let's see. I think the biggest thing, just to kind of put a bow on this really quick, the biggest thing that we're trying to establish the health of the overall real estate market, again, is the supply-demand curve, and really the interest payments and mortgage payments, right? So unemployment has skyrocketed. the biggest concern in our mind is over mortgage delinquencies. Basically, we've seen that number rise. There's frankly not a whole lot of data. You'd be surprised out there right now. A lot of it is still, I think, done on a quarterly basis. So much of that is from Q1. There are some initial observations and trend lines. Black Knight is kind of like CoreLogic. They do a lot of data analysis and have a ton of access to data. And, they saw, I think in April, something like $1.6 million delinquencies in mortgages. So it sounds like a big number. Obviously, overall, it's actually not as large as many people have been predicting, which is a good thing. But if that, that could change at any moment, right? We had the government intervening with the CARES Act and the PPP money to help support, Main Street businesses and 1099 folks. So the question is, when that money runs out, are we going to be back to where we started? Are we going to see a higher amount of delinquencies? I think the answer, and I don't have, I don't know for sure. If I did, I'd be a trillionaire. But I think the answer is that the Fed is going to do whatever it has to do to backstop this economy. And I think the government, regardless of it being a political year and, having probably the most heightened divide in parties that we've ever seen, I think that everybody will come together to make sure that the economy is moving and the engine is back online. So, the Fed has already showed that it's willing to expand its balance sheet tremendously. We're something like $6.2 trillion now. So, they've shown that part of their monetary policy. Chairman Powell has talked about even buying equities if they have to. So, I don't think, I think that they will go to any lengths to make sure that the economy continues to prosper. And so that's why I'm pretty bullish on real estate right now. Even if there is another lockdown, even if there are additional waves, I think the market is starting to price in the idea that this could last, frankly, through even 2021. Who really knows here? I've heard reports that the virus has started mutating and it's not quite the same virus that it was when it first hit our shores. So it's very likely that these other waves happen. And I think as difficult as quarantining ourselves has been and trying to adapt to this new lifestyle, I think people are starting to get used to it. And we understand that it's life and death in many people's cases, and we can continue to have thriving businesses and move forward in real estate, even in the midst of a pandemic, as crazy as that sounds. So I will leave it at that on that slide. Now, as far as the impact on lending, I got into this a little bit before I jumped back. The biggest thing that we saw was rate increases, right? So right off the bat, there was higher risk, March, April. Not a lot of people knew what was going on. So what you had from most every private lender out there, hard money lender, even banks, were COVID pricing, right? And so what that meant was overnight, when our lows were 6, 7, 8, we jumped up to 10 on the interest rate. That meant for points, when we were as low as 1%, we had to jump up to 3%, right? And this, again, 10 and 3 we were hearing that from pretty much every other lender out there. I don't know how everybody synced up, but that's just how it played out. Additionally, we saw some other factors that I'll get into shortly on the next slide. So the big thing was just tightening, right? With the unknown, a lot of higher risk, not sure what was really going to be happening at the time. Since May, we've really started to see a lot coming back online. So again, the beauty of being a lender, being able to see kind of that high level overview. I could tell you that we were, I won't say numbers, but I can tell you right now, as of May and just finishing up June's numbers, we're closing out the books right now, but we are about 50 to 60% of volume that we were doing in early Q1 and probably Q4. So point of saying that is we're not back 100%. I don't think any lender is. And that's because there's a big piece of the market that's still on the sidelines waiting to see what's going to happen with additional PPP money, waiting to see what's going to happen with additional delinquencies and mortgages. How's that going to affect things? Is the Fed going to continue to keep rates low and monetize debt and all of the other things that are required to kind of keep things moving right now? So unfortunately, I think for a lot of those people, they're going to be disappointed. They got to the sideline, which was probably smart. But I think with human nature, maybe you agree or disagree, but especially here in America, I feel like when we have a crisis, we tend to go to the opposite extreme. And I think that a lot of risk-averse people are going to really take some time off and just say, I'm not going to jump back in, even though that might have been the right thing to do. Perfect example. I think that had you, a lot of people are hurting from the stock market right now. I don't think anybody would disagree, right? However, if you had jumped in, kind of at the bottom in late March, you could have essentially ridden that up in many, blue chip stocks to almost pre-COVID levels. And really, even though there was all this uncertainty and risk, that could have been a hugely profitable move on your part, right? And you've seen this with a lot of millennial traders using apps like Robinhood and others, M1. And the same goes for real estate. The opportunity is now. From all the data that we're seeing, this is not 2008, 2009. This is not mass foreclosures, bottom market deals where you're getting 10, 20% off pre-crisis numbers. It's just not happening. Prices are continuing to rise. So I think if that's what you need to do, because that's how risk averse you are, and that's your personal profile, I understand that 100%. But you may be missing out on good opportunities in the meantime. And especially on some longer term projects. If you have the ability to, if you're interested in getting into bigger projects, right, condo conversions and things like that, this is actually a great opportunity for that, because those projects, on the short end take 18 months. You might be in that kind of project for 18 to 24 months. And I mean, who knows what's going to happen in 2 years? But I can tell you that it's going to look a lot better than it does right now. It's just the nature of numbers. Like it's going to play out that way. You can't inject trillions of dollars into the system and not create another bull market. I mean, why do you think there was the largest bull market of all time? From 2008, 2009 to 2020. I mean, it was because we put trillions of dollars into the system. So, that's great. At the same time, there's inflation. So like Nhan said earlier, you need to be looking for opportunities that give you great returns. Cash may feel safe right now, but it's widely understood that with inflation, you're probably losing 2%. I just watched a video from Ray Dalio. He's an amazing guy, Bridgewater Associates CEO, largest hedge fund in the world, I believe, with assets under management. You're losing 2% per year just sitting in cash. So if your money is not working, you are losing money just sitting in the bank. So I implore you to find good real estate opportunities and long-term projects as well as short-term projects. Let's see, capital conduit, secondary market. I touched on that. I won't get into that too much more. Just trying to keep track of time here. I also mentioned tightening requirements and liquidity. And and 3 to 6 month projections, again, I think that there's a very strong likelihood that we end up back in lockdown in many states, potentially. I've been hearing the term nationwide lockdown, like many countries have. I think that could be a possibility. Real estate is going to be a necessary industry that will have to remain open. I mean, it did earlier in late May, late April, March, or most of April. It's going to continue to do that even if there's another lockdown. So I'm not so concerned about that. We need to get these rates under control and get the numbers back down. But there's, like I said, the market has already kind of priced that in. I don't think you're going to see home prices suddenly fall because we go into another lockdown or because there's another wave. We're already seeing the wave, right? We're seeing it in Florida and Arizona and all sorts of places. And that's only probably going to continue for the time being. So our projections are very bullish despite everything that's going on. And I think you could be missing out too if you're on the sideline for too long. So moving on, getting your deals funded. The big things, again, that we saw, I touched on it a little earlier, higher rates, right? Like COVID rates, increased closing times, prepaid interest, higher points, longer construction draw timelines. Those are some of the big factors that we saw immediately after COVID. So if you're out there looking at hard money lenders, it would not surprise me if many of them are still using these rates and these COVID terms. So don't be surprised, including one thing that's not listed here, LTVs and LTCs. So those tightened up, right? Prior to COVID, you were seeing, a lot of cases up to 90% loan to cost, which is purchase price plus construction budget times 90%. That was a big metric that many lenders use to lend. And we saw that fall from 90% as a high down to 80% as a cap. So that was a big shakeup too, because now you needed more money to get into the deals. So for many people, it priced them out. So talking about where we are now, the big difference from us in late March, early April to today, with all of our other capital raising, we've done tons of capital raising over the last 2 months. We've gotten some great credit facilities online. We've now gotten our rates back down to closer to basically 8%. So as of now, we have an 8% for 6, 12% for 6 product. This is great for single family flips where you think you're going to be in for 6 to 8 months. At 6 months, you're blended at an annualized 8% rate. If you happen to go to 8 months, you'll be at something like 8.5%, 8.75. So still a really solid rate. We do have an 8.99% rate for 12 months. And I would tell you probably within the next 30 to 60 days, we will likely be at a flat 8%. So, as I mentioned before, and where we were before at 6, 7 on the low end, in many cases even 8, we're starting to get back to that point. So I can't say the same for all lenders out there. You're still going to see a lot of those COVID rates, but we've started to see things normalize pretty heavily. We went from 3 points, which we do still see in some deals, depending on things like credit score and track record. Those are key factors that play into what the rates ultimately are. But we are now down as low as 1%, 2%. So we do have the ability to be very price aggressive. The big changes that we think are probably sticking around, at least on the short term, and in short term, I mean probably for at least the next quarter, so 30 days, 90 days. You're probably going to see most lenders sticking with their requirement to have prepaid interest. Now this has been a sliding scale, and we're seeing it right now with our own products. 3, 6, 12 months are kind of the scales, and depending on the other factors of the deal, we can probably keep that to 3. If your track record, credit score, cash to the deal all look good, the leverage is good, there's no reason why we shouldn't be able to get you just 3 months. So the cash to closing doesn't have to be that affected. And especially on smaller deals, at 8%, 3 months is relatively small. So that is obviously a big part of a symptom, so to speak, of the delinquencies that we're seeing across the board. So, lenders are being more cautious about the ability for their borrowers to pay them. And for you in planning your own projects, if you're raising your own capital, one of the key methods of finding money for a deal that Nhan mentioned, raising capital from a fund, from a private individual, or whoever it is, make sure that you are getting enough operating capital to float the project for however long you really think it's going to take. That includes payments. I mean, don't think, okay, well, this is a 12-month loan, so I've got about 6 months. I don't think it'll take longer than 6 months. That's a recipe for disaster. I would just go ahead and raise that extra 6 months just to be safe. And I guarantee you will not regret it over the long run. So prepaid interest is a big thing that's probably sticking around for another quarter. The other that we haven't really seen recover are LTCs, LTVs. So we are at 65%. We can, in many cases, go to 70% loan to value. For LTCs, currently we're capped at 80%. So that has been a big effect. Obviously, we were doing up to 90% previously. Currently, we're at 80% loan to cost. Again, purchase plus construction times 80%. What we can do, and what we've just implemented as of a week ago, are we now have the ability to do a second position loan for another 5%. So we can essentially make up some of the ground in a new fund that we started that's a little bit, takes on a little bit riskier debt. So you're able to, get into a deal at basically 85%, all from the same lender. And again, talking about where are we going, what's the trend, you will likely see that first position note bump up to 85, and the second be that other 5% to get you back to the 90 that you were at post-COVID, so pre-COVID. So, at least in the next 30 to 90 days is where we're headed with that, most likely. But there are plenty of other lenders out there right now that are just not able to do the seconds. They're not interested in that. So the key thing for us there is our seconds have to be behind, our own first, right? That allows for a little bit more protection. So as far as rates on the seconds, they kind of range wildly from 12 to 18% and 3 to 8 points. It really just depends on all these different deal factors and the risk of the deal. However, keep in mind, the smaller your deal, the smaller this 5% is going to be. So even though those numbers kind of feel a little crazy, the actual dollar amount is really not all that punitive. So it's not as bad as you think. I would be happy to go through some numbers with anybody who's watching that may be interested. Feel free to send me a message to my Facebook. You can send me a message in the chat, and then I'll answer any questions later. I'll give out my email address and everything shortly. So everybody who wants to connect with me can connect. So that's the long and short of it. I don't want to go too long. I know we wanted to have about 10, 15 minutes for questions. So I'm going to hand this back to Nhan now. And again, thank you so much, Nhan.
Jared, can you hear me?
Yes. I got
Okay,
you.
fantastic. Well, I appreciate it, and very, very thorough, guys. Hopefully, you guys got a chance to learn a lot from Jared, one of the most respected individuals, and I tell you, he's helped lead Washington Capital Partners to where it is today. And it's funny because Jared mentioned don't want to stay in the sidelines too long. Last time I checked, the people who are sitting on the sidelines don't have much results. Okay, so make sure you get out of the sidelines, go back on the playing field, and whether you have a completed pass or an incomplete pass, at least you have some activity to learn from. But what I do know that if you're on the sideline too long, you're not going to have any results. Okay. Also, Jared mentioned a lot about the stock market. For myself personally, I love investing in real estate. And the reason why I love investing in real estate is because it's controlled, and I don't leave my financial future in the hands of a board of directors or maybe the officers of any particular company. Excuse me. And anyways, but however, because of the discounts on the stock market in the last couple of months, I was so tempted just to go ahead and go at it. And I would start investing in options, and one in particular options that I did. Mind you guys, options is very sophisticated, so you can easily lose a lot of money there if you don't know what you're doing. But if you lose money, you lose small. If you win really big. And I had just played around with $1,000 in the month of May, and just a few weeks ago, in the middle of June, we were able to sell those options and made over 1,100% return on that money. So we bought in 1,000, got back out 11,000 some change, and that's literally unheard of where you're putting your money inside a savings account. So guys, those are the kinds of returns I'm talking about. When I say return on investment, I'm not talking about a measly 5, 6, 7, 8% that the bank advertises, or the 401k person advertises, or the salesperson who's selling you a mutual fund advertise. I'm talking about some real returns when you become a sophisticated investor. Okay, so moving on to the different types of money you get access to. We talked about hard money. There's also private investors. So Jared mentioned that they can fund up to 80%, and 85% use a second position loan that they have available to. But what happens with the 15% that you have to come up with to make sure you have no money in? Well, you can go to private investors, people that you know, like, and trust, and tell them that, listen, you're trying to raise X amount of dollars to do this particular deal, whether it be a fix and flip or whether it be something you're doing, and you want to give them some kind of return on investment. Okay, you can negotiate these kind of returns, and people on average on their savings account right now are earning less than 0.5% in their savings account. Just imagine if you offer them 6% on their cash, would they be happy? Absolutely. If you offer them 6% and they originally earned 0.5%, that's 12 times the returns they're making if they kept their money in their savings account. So why would they not want to invest with you? And the only reason why they wouldn't is that you did not do a good job selling the security of that asset. Real estate still today is one of the most safest investments in all types of investment classes. And the reason why is because people will always need a place to live, and there'll always be value in real estate. The same cannot be said in the stock market, because companies come, companies go, and we never know based on the management of the company how they're going to perform over a period of time. Okay. In addition to that, we have equity partners. I'll go through this really quickly. These are the people who you can actually go with, and if they have a lot of money in the bank, let's say several $100,000, they can literally fund everything for you with the renovation and also the acquisition. And then maybe at the end of the day, you manage everything with regards to the value add and the renovation. And then once you sold the property, you now split the profits. All right. They're sharing the risk with you, but then you save. But then you actually make less money than had you got a hard money lender, because now you're splitting the profit instead of just paying a straight interest rate and also points. Okay, and then conventional loans, we'll go through this really quickly. Most people are already familiar with this. This is a typical mortgage that's either a commercial mortgage or a residential mortgage, consumer mortgage, that you use to finance a deal, whether it be a fix and flip, or whether it be a rental property. Okay, now usually if it's a residential consumer mortgage, it's usually bought under your personal name, which is what we don't recommend. However, if you're going to purchase it under an LLC, then you'll need to get a commercial mortgage. So that way the LLC is the main borrower, and most likely you'll be the guarantor on that loan personally. So these conventional loans tend to be much cheaper than hard money loans. However, the downside is that they do take longer to close, because they'll need to underwrite it. They'll need to get an appraisal. They'll need to do a credit check. And it just takes longer to approve, because if you have a very good deal and the seller is very motivated in selling you the deal, and their biggest value proposition is for you to close fast, this completely goes away if you use conventional loan. So what you want to do is if you have a very motivated seller who needs to sell like yesterday, definitely go to a hard money lender, because they will close much faster than if you use a conventional loan. Okay, seller financing. Well, what is this? Well, if the house is free and clear, you can negotiate with the owner to say if they can hold the mortgage on the actual property, and then you come up with the money through a private investor or a construction loan to be able to finance the renovation. So this has been very, very popular as well, because it's easy to work with, and you can work directly with the seller on the terms that works for you, and not tied to the terms that are tied to a hard money lender or whatever criteria that other lender has set for you. Also, personal equity. I like to say that your personal wealth, never undervalue how much you're worth, because you're worth so much more than you think. Bill Gates famously said you should never undervalue your assets. I mean, never undervalue how much equity you have, whether it be your lines of credits, your retirement accounts, your home equity, or even your cash. Okay, so I mean, what are the pros for using personal equity? Well, it's easy to negotiate with yourself how much return you can give yourself. Okay, the cons are that your return of investment goes down because you're using your own money. So now you're putting a number inside the denominator for return on investment, and now the percentage is no longer infinite. It's now some kind of finite number, and if the number is high, that might be doable, but again, it's still a number nonetheless. Personally, I just like infinite returns, but you can choose to do this if you want to settle for a high percentage return. So the important skills and value that you would need to have in real estate investing, especially if you want to be successful long-term and not be what I call a one-deal wonder. What I mean by that is you do one deal and you wonder what happened. I see a lot of people out there who do one deal and have no idea how to do the second one. All right. You got to establish skills and values to be able to create a long-term sustainable business. This requires your ability to assess value in any marketplace, especially in the times of a pandemic. How do you assess that value? You also need the ability to raise capital. How do you raise money when things are tough? Okay. You also need to have the ability to negotiate. Negotiate with your motivated sellers, negotiate with your lender, negotiate with your contractor, negotiate with everybody. Okay. Negotiation is key to getting a good deal in all aspects and all fronts of the actual deal that you structure. Your ability to build a win-win relationship. See, I really believe in teamwork, because if you don't work with your team to make them win as well, then that good team member may not want to work with you anymore, such as your lender or your agent or your contractor or your lawyer. So you got to build a win-win relationship to where when you make money, you ensure they make money as well. And you apply the Zig Ziglar philosophy that if you help other people get their bills paid, then your bills will disappear. If you help others get what they want, you will ultimately get what you want. Your integrity is very important. Okay, and what I mean by this is, doing the right thing even though when no one's looking. Now, I'm not talking about lying or not lying. I'm just talking about doing the right thing, okay? And even though no one's looking, you're not looking for any kind of a recognition for doing the right thing. Your generosity. I really believe that you give more, you'll also have more, okay? And so if you do well in a deal, don't be afraid and don't be shy to share a bonus with the team members who help make that happen. I also believe in performance bonuses, because if they perform well and I pay a bonus, it's going to incentivize them to perform well again. So your generosity is key if you're going to build a long-term successful business and retain strong, good team members to help build your business. So let's go through a couple of examples right now, so that way you can kind of see what I mean on how to raise money, how to have it apply to you and make some decent money without using any of your income, okay? So this is a deal that we did in Southeast DC. Our purchase price was $145,000. It's a semi-detached home with 2 bedrooms and 1 bath existing. We turned it into a 3-bedroom, 2-bath after it's all said and done. The renovation cost to do all that was $80,000. So let's take a look at the actual numbers itself, okay? So you may not be able to see on the left-hand side here, but this is the HUD settlement statement showing the exact numbers of what we needed to get done. Since the renovation was $80,000, all right, the construction draws at escrow was escrowed at its closing was $80,000. So they withheld $80,000 in escrow. Okay, so you take a look at the HUD, the cash due at closing was roughly $65,000, And if we're going to assume that we're holding this property for about 6 months, we have to account for the interest, the real estate taxes, and the utilities, or any HOAs, if there is an HOA, just like what Jared said about having working operating capital for your deal. If you add all these numbers together, we needed an extra $80,000 in addition to the hard money loan on this particular property. Okay, so you ask yourself, how do where should this money come from? Okay, well, here's where the money came from. Okay, so if you take a look at the actual cost here, all right. When we sold the deal, we bought it for $145, put in $80,000. We sold it for $350,000 about 6 or 7 months after we purchased it. All right. Now you notice there's a concession of $10,408. What that is seller subsidy. We gave the seller $10,000 in closing help. So really, we netted approximately $340,000 once all said and done. Once all the real estate agent commissions and the closing costs were done, we had a total cash at closing of $145,000. Now, if you remember, we borrowed $80,000 from a private investor. We gave 10% interest to this private investor over a period of 6 months. You do the math, over 6 months, that's $4,000. Okay, so you take $145,000, subtract $80,000, subtract the actual interest that you paid to the private investors of $40,000. What do you have left over? $61,000, which is money in your pocket as profit for the deal once the deal was done. So take a look at this. Once you earn the $61,000, what is the percent ROI on this profit? Can anyone answer? The answer is infinite. And the reason why is because we use none of our own money. And it's kind of like printing money out of thin air for yourself legally, because you're using debt and you're structuring it properly to where everyone makes money. Your hard money lender made money here. My private investor made money here. The contractor made money here. The hard money lender made money here. The title company made money here. My agent made money here. And then we made money as well. Okay. Everyone made money in this deal because it was structured properly in a way to where we made a decent return. So take a look at how long did it take for us to earn this money? How long did it take to realize this profit? Well, it took 6 months to get this deal done, from renovation to putting on the market to getting on a contract and getting it closed once the settlement was done for the buyer. So you do the math, $61,000 divided by 6 months is roughly $10,000 per month. And this is just from one deal. And you can easily do this on a part-time basis, okay? So how many, with that said, how many can you do on a simultaneous level, okay? Well, if you know how to raise money properly, you can do as many as you want, because the possibilities become limitless, because you're no longer constrained by how much money you personally have in the bank, and you have the skill set and the ability to raise your own money, negotiate the deal, and get a great deal for you to be able to fix and flip or do whatever you want with it as an exit strategy. Everyone makes money, and you do as many as you want because you have the skill set. The biggest value you have is not anything that you have here with regards to the deal, or whether the biggest asset you have is your skill set to raise money and negotiate a great deal. Okay, if you have those skills, you will be unstoppable, especially in real estate. Now, you'll be unstoppable anywhere in life, but you'll definitely be unstoppable in the areas of real estate. Okay, so let's go through right now. We've actually finished the slides here, and what we're going to do right now is go through a couple of questions that you guys may have had for either myself or for Jared through here. So I'm going to turn it over to Nicholas to go ahead and go through the questions. Okay.
Hello, Nhan. Can you hear me?
Yes, I can. Go ahead.
Okay. So this first question is for Jared. It's from Alan. He asks, do you anticipate, as we learn more about mortgage delinquency rates, that institutional capital will tighten up, or will the lower potentially high returns loosen up some of the access to capital?
Yeah, that's a great question. Thank you so much. First of all, can you hear me, everybody?
Yeah, we hear you.
Okay, perfect. Yeah, great question, Alan. I think that there's a possibility that these institutional capital groups, these funds, and the secondary market, and when I say funds, we're talking about pension funds, we're talking about hedge funds, right? All sorts of different pools of money, basically, wealth funds. So all of these groups, again, are looking for good returns. I could see how the possibility of that could lure them out, and it already has, right? The pre-COVID, the post-COVID rates that we're talking about, are really what they're going to want. So what's weird about this whole scenario, right? 2015, all of this money piles into the hard money lending space, the fix and flip space, and it drives these all of the financing costs down to be more competitive with banks. It opens up. It's a great thing for everybody, right? Everybody gets cheaper access to capital. The challenge now, and what's basically been flipped on its head, is in order to get access to that institutional capital that could help lenders scale, they actually have to charge higher rates, which it works against itself, right? So I personally think that I think all this institutional money is going to be forced, if they want any business at all, to adjust. And that's why I was talking about this dichotomy and the split of hard money lenders. There's going to be the hard money lenders that have no cash. They've got their own, a little bit of money that they could raise, and then they're just selling loans, and they rely on these institutional investors. And so their rates are going to be high. And then there's going to be this other segment of the hard money lending space, including groups like ours that have figured out a different way to survive without the institutional money. We're going to continue to see rates lower. So that's really the big thing. Even with delinquency rates increasing, there are a lot of laws and regulations that have been put in place to allow for forbearance. I know that in some areas they're still trying to figure that out. We've seen very, very strong payments from all of our borrowers, which we truly love and appreciate. The reality is, right, at some point, we're a middleman. We've raised all this money, and we have to pay interest on that money to somebody else. So we're making a spread in the middle by giving access to capital. That's what it is. It's giving access to the masses to be able to do their flips. That's challenging for a group like us, because if on one side the regulations are saying, I'm sorry, but you have to allow forbearances, and then on the other hand, you have your investors that are saying, well, I still need to get paid every day, or else I want my money back. You're left holding the bag, and you have to hope that your balance sheet can support the pull of both of those things. So we've been tremendously lucky that everybody that we work with has really good operating capital and can continue to pay. And we haven't had too many issues with that. If it increases, that is part of the reason why you're seeing lenders do this, prepayment, kind of prepayment interest, right? So you collect some of that interest up front to protect yourself against the possibility of late payments, of delinquencies and stuff. So that's kind of what we're seeing there. I think if that increases, those institutional guys are going to go away again. But frankly, I don't care, because we're pivoting. We've pivoted to a point where we don't need them, and I'm very excited about it, because it allows for us to continue growing nationwide, which is one of our big incentives. One thing that we're actively trying to do. So.
Okay, cool. I don't want to butcher this name. Boniface. They asked. They understand that COVID. This is for you, Jared, by the way. They understand that if COVID has had an impact on the economy as a whole. Have your lending requirements to flippers changed accordingly? If so, what has changed? If so.
Yeah, I think I touched on this, but just to briefly glance over it again. Yes, of course, with higher risk came post-COVID rates and terms. Now that is slowly pulling back. And again, we're getting very close to pre-COVID numbers again, all things considered. The two big holdovers that you're really seeing are just kind of that prepaid interest, which again, we can kind of try to keep, depending on the deal, at 3 months on the low side. So it doesn't really have a huge impact on cash. And then the LTC, which again, we've created a creative solution to that with the seconds. And I believe that we'll continue to see that loosen up as we move forward through Q3. So, yeah.
Okay. Let's see here. So this next question is from Carlos. This is for you, Jared, as well. He said he will be doing his first flip soon. And can you explain the loan that you offered for a buy and hold?
Yeah, it looks like Boniface also referenced the 30-year mortgage. So it's good. There's two questions about the buy and holds. Long story short, the 30-year product, right? You basically have a couple of groups out there that have this product. You've got some local banks. These local banks, oftentimes, they're reporting this debt. They may want you to buy it in an individual name as opposed to LLCs. And this can have an effect on your overall debt to income ratio. You're also probably going to have seasoning requirements with most local and regional banks. So that would mean that you'd have to buy the project in cash potentially, or with another loan. If you're going to do construction, do the construction, right? If not, if it's already fully livable, then you're going to put a tenant in there, and you're going to have to season that and collect rent for, we're seeing 3 to 6 months in the banking world. The product that we had pre-COVID, there was no seasoning requirement. In fact, you could actually get this product without having a tenant in there for the first 6 months, which was just mind blowing. And there was a rate adjuster down. So once you got it tenanted, the issue with that is that product was coming from the institutional world that basically all but shut down. This is something that's really fallen off across the board in private lending, because the institutional groups that were providing this to many private lenders have stopped providing it, right? Their fear is, oh my gosh, all these mortgage rate delinquencies are rising. The last thing we want to be in is in a 30-year note with the possibility of delinquencies, and so that really scared that product out of the market. There are now some of those institutional groups are coming back online, and they will be offering it, but it's slow. Like we're talking about probably not having it fully up and running, and probably higher rates than it was before. Previously, we were looking at somewhere in the low fives on kind of the low end. I've seen some of these institutional groups with the same kind of product, like up at 6-7%. So it's definitely increased. But I think some private money lenders are offering this now because a couple of these funds came back online, and they're willing to offer it, but they're like, well, we're going to upcharge you basically for the perceived risk. So what we're doing to actively change this and counteract it so we have a product for market is in one of our credit facilities, warehouse lines, we've actually carved out a big chunk of this facility specifically for this debt, for this long-term rental debt. We are hoping to have that in the next 3 months, probably more like 1 to 2 months, but I'm just calling it 3 months. It'll likely be 1 to 2 months. And this is going to be, back at those numbers that we were seeing pre-COVID. So we're really excited about this. This is, if anybody who's taken some of this debt, this 30-year debt, knows that it's much more complicated because it is an institutional product. So we're hoping to have a little bit of a smoother process with that and take away some of the paperwork and headaches that were involved with that. So definitely look out for that. Keep checking in with me if you have my contact information, just here and there every 2 weeks or something like that, just to see when it's online. And we'll be happy to help you out. So great question.
Okay, awesome. All right, we have time for one more question. This one is for Nhan. Alan asks, on options trading, do you use Tastyworks or Tasty Trade?
Well, actually, that's beyond the scope of this presentation. But just to answer your question, no, I do not use that. I actually use TD Ameritrade. They're fine, but I would wish I could have a better platform to see things at a glance. But again, I'm not advocating options trading or stock trading. Again, because of that reason of not having control over your own investment. However, just because we see ups and downs in the market, whether it be a recession or whether it be driven by a pandemic, we know there are certain industries that are just not going to fail because the government will not allow it to fail. And its history has just proven it over and over again, at least in my lifetime. So if history is any indicator, then you can use history as a prediction of some of the future in certain industries. All right. So hopefully that helps out. And Nicholas, I believe, is that the last question?
Yes, it looks like that's all the time that we have for questions. So I'm going to go ahead and turn it back to you, Nhan.
All right, Nicholas. Well, thank you very much. Well, guys, I really appreciate it. What we're going to do right now is we have an actual raffle coming up here. And the raffle is designed for us to allow the attendees to win a free 30-minute mentoring session with myself. And this has been very popular since we started it last year. So to do that, we actually have something really cool. And I'm going to turn it over to Ari. And Ari is going to go ahead and go through the raffle by sharing her screen with something that's really fun. Ari, are you there?
Yes, hello, can you hear me?
Yes, we can. Go ahead.
Okay, perfect. So let me go ahead and share the screen with you. I hope this whole meeting or the webinar itself was self-explanatory. And if you have any questions, again, we will go ahead and share Jared's contact information for you guys right after this. Can you see my screen?
Yes, I can. Go ahead.
Okay, you guys, so we call this Wheel of Fortune Homes. So good luck to our lucky winner. You will be winning a 30-minute session, a free 30-minute session with Nhan Lam himself. And hopefully you guys take advantage of this because this is of great value, which is given to you for free. And the winner is Jeff Wu. Okay, Jeff Wu, I'll be going ahead and contacting you via email and sending you a request of what time you'd be available to go ahead and meet with Nhan. And congratulations.
All right. Thank you very much, Ari. I really appreciate that. And Jeff Wu, congratulations to you, sir. Definitely look forward to talking to you. And, if you need help getting started in real estate, we'll definitely get you started there. But if you're already an experienced real estate investor, then we can talk about how potentially we can do deals together in the future. So that's how we have done things in the past. And it's been very successful with helping the community to be able to work together with us. Okay. So going back to our presentation, is the next slide here is that next week on July the 8th, we have a special event for those who have been attending our webinars for free at Nhan Lam Academy. We actually have a very nice topic next week on how to make $10,000 to $100,000 in wholesaling. And one of the reasons why I love wholesaling is because you can literally make money in real estate with none of your money. You don't even have to buy the property. You don't have to take title to it. You don't have to get a loan. You just have to get under contract and sell the contract. So we will go through this in detail on how you can accomplish this on a part-time basis with very simple techniques and very simple negotiating things. You can RSVP for this event at www.nhanlamacademy.com/events. On that website, you'll see a little button at the bottom that says reserve your seat. Make sure you reserve it because we're only holding a very limited number of people into this webinar. You can also register for this event on the top here with the RSVP now button at the red button. It goes straight to the website where you can RSVP, put your email address in, and get yourself secured for that event next week. All right. So next month, guys, for our meetup, our next topic is how to rehab for big profit. It's going to be done on Wednesday, August the 12th. We're going to be having a panel of people on this webinar. And we will be doing a webinar as well. We will not be going back to the Gainesville, Spring Hill Spring Hill Marriott anytime soon, just because of the spikes and what's going on in the world right now. We're going to go ahead and keep things virtual, most likely for the rest of the year, but we'll be monitoring this on a very monthly basis. So next month, we will be having this event virtually again via Click Meeting. We're going to be having a panel of folks who have done fix and flips as a career, and they're going to be sharing their 2 cents on what they've been doing that's been working, what they're currently doing right now, and also what they're seeing as their vision in the future. And you guys will get a chance and have a discussion group where we actually open up the entire panel, and you guys can speak to these people and ask questions in an orderly fashion, so that way you can go ahead and get some great information from everyone's perspective in different marketplaces, both in Virginia, DC, and also in Maryland. So guys, with that, we look forward to seeing everyone next month. For those who are interested in rehabbing, we look forward to seeing everyone next week. For those who are interested in wholesaling. And with that, thank you very much for attending tonight. We look forward to seeing you guys in the next events coming.